Students, we will now deal with inventory counts and also have a look at those substantive procedures for the inventory cycle. So why are inventory counts so important? From a business perspective, an inventory count is an excellent tool for management to control the movement of inventory within their business. And from the auditor's perspective, it provides excellent audit evidence in terms of valuation, completeness, and existence of inventory in the business. If planned and executed well, the auditor can most definitely rely on the inventory count or the evidence provided by an inventory count as excellent audit evidence. When it comes to the planning of your inventory count, the first important step that needs to be done properly is the fixing of the date. Now, it can be that an inventory count can take 1 day, or perhaps in some cases it can take more than 1 day. So these dates or this date has to be communicated to the concerned employees well in advance. For the fixing of responsibility, it's important that work is clearly defined and that all staff members involved are willing and able to cooperate on the day of your inventory count. Okay, so this is done by taking your inventory storeroom and dividing it into sections, assigning each section to a supervisor, and then assigning different counters to each supervisor. In terms of the control over stationery, it is important to maintain control over the medium that you will use to record your inventory count. Okay, so this is usually done by making use of count forms. So these count forms have to be pre-numbered, and a record has to be kept of count sheets that have been, or count forms that have been issued. All right. So inventory count sheets or tags are used, and these tags at the end of the count has to be checked against a pre-listing. Parallel to this control is the numbering of all shelves and or bins in which inventory may be kept, the pre-listing of all such numbers, and accounting for them on the inventory count sheets at the end of your inventory count. Okay? In terms of inventory movement, there needs to be very strict controls around whether inventory comes out or goes out or comes in to your inventory storeroom during the count. Now, in theory, inventory remains the property of the seller until delivery takes place. However, there could be a situation where you have unopened packages from suppliers for which invoices have not been received, and these could be omitted from inventory. Or on the flip side, you could have sold inventory, set them aside and invoiced, and these may be treated as sales. Okay? The important takeaway from that is there needs to be strict control over any inventory movement. All right? The entity needs to decide on a cut-off point. Now, this exact point in time is a point where which goods received can be included in inventory and sales made treated as a reduction in inventory. All right, so there needs to be a clear cut-off point established for your inventory. So once all this has been decided, these instructions have to be issued to staff. It has to be issued well ahead of time so that staff members can have enough time to familiarize themselves with these procedures. And during the period leading up to the inventory count, inventory should already be prepared. So in terms of neatly stacking your inventory items, keeping your aisles clear, and any other means of facilitating a smooth inventory count needs to take place ahead of time. During the actual execution of the physical inventory count, the following controls have to be present. So the actual counting and recording of the inventory should be done under proper and strict supervision, and instructions have to be strictly followed. All right, so the provisions should be made for the counting and recording and checking to be distinct functions. Where there are no inventory records, inventory items should be counted twice, once by each of two separate count teams. Now, when it comes to the count teams, these teams should consist of at least two employees. One should be doing the count and the other should be recording the count details. It can be that there may be discrepancies that arise between these two quantities. It is just then important that there is a procedure in place that the count team can follow in terms of reporting it to a supervisor and adjusting your inventory records. All right. It could lead to a further count having to take place to establish what the true quantity of the inventory on hand actually is. Important is that that procedure needs to be laid out ahead of time. All counters and recorders and checkers should sign and initial the count sheets and also identify what their function in the inventory count actually was. At the end of the inventory count, all these count sheets or tags issued, whether they were used or unused or spoiled, have to be accounted for, first to each supervisor and then to the executive in charge of the whole inventory count process. The auditor also needs to receive these inventory count instructions ahead of time from their client. And it is now up to the auditor to ensure that these instructions are actually followed by their client. And the way that they do this is they attend the inventory count. And at this inventory count, there are a number of things that the auditor needs to observe. For example, the layout of the premises, are all the inventory items marked properly? Have they been marked once they have been counted to avoid double counting, that sort of thing. They also have a look at how count sheets are issued and are they signed as proof that they have been completed and reviewed by the count teams and also by the supervisor. How is damaged stock being controlled, or how are they being accounted for in the inventory count? And then the auditor also conducts his or her own count. They can also make photocopies of the count sheets just to ensure that changes are not made to these count sheets subsequent to the inventory count. At the end of attending the stock count or this inventory count, the auditor then reports any weaknesses that they've identified in the procedures to management. As I previously mentioned, the auditor performs his or her own test counts, and this is done for two main reasons. The first reason being so that the auditor can ascertain whether the count procedures have been properly implemented and also have been documented in sufficient detail. Okay, so the auditor should be satisfied that not only have the counters observed the formalities laid down to them, but that they did in fact record the correct inventory quantities. All right. The second reason why the auditor performs their own test count is after having observed the effectiveness of the control, the auditor should be satisfied that the record of inventory is actually acceptable for incorporation in the financial statements and that all the relevant assertions have been covered. We now move on to the last part in this topic, which is substantive testing. Before ascertaining the level of substantive testing that the auditor will perform, it is important to first of all understand all of the activities within the cycle. Also, tests of controls need to be done. Then based on this assessment, The auditor will then decide whether they will be doing limited substantive procedures or detailed substantive procedures. The million-dollar question here is, what is the risk when we are dealing with inventory? So first of all, we need to look at what will the direction of testing be. Now, as you know, inventory has got a debit balance. Therefore, our primary risk for inventory will be the overstatement of your inventory balance. The risk of overstatement requires the auditor to test transactions then from the general ledger to the supporting documents. Okay, so further to your direction of testing, it is also important to understand which assertions are then either primary or secondary, and which assertions are standard assertions when you are testing for overstatement. All right. So it is important that all assertions must be addressed by your procedures, but the majority of your marks will be generated under your primary assertions. Okay. Remember that you always have to audit by assertions. Okay. And then also important, and we'll deal with this a little bit later, is that there are certain general substantive procedures that have to always be performed. You'll see an example here on the screen of an inventory balance that has been disaggregated into different parts. Okay, so it is important also for the auditor to design procedures aimed at addressing each type of inventory. As I mentioned earlier, there are some standard audit procedures that we always have to perform, and these include the following: obtaining a management rep letter, agreeing opening balances from your prior year closing balances, the overall review of your general ledger accounts just to identify any abnormal movements or any unusual entries, testing castings and calculations in your general ledger or any other documents or reconciliations, agreeing the total to your general ledger, of the general ledger to your trial balance and your financial statements, and then evaluating the effectiveness of internal control and the impact thereof on the nature, timing, and extent of your substantive procedures. Inventory is usually viewed as a significant balance in your financial statements. Therefore, the misstatement of it could have a significant effect on the financial statements. Therefore, the auditor is always concerned with the fair presentation of inventory in the financial statements. Also, taking into consideration any Companies Act requirements that could affect inventory would be important to the auditor, and also your accounting standards and whether the requirements in terms of IFRS and IS2, which is the accounting standard for inventory, has been complied with. In terms of IS2, inventory is defined as an asset. It can be either held for sale in the case of finished goods or goods held for resale, or it can be in the process of production for such sale. So that would be in the case of where you have items that are work in progress, or it could be in the form of materials or supplies to be consumed in the production process or in the rendering of services. In that case, the standard refers to raw materials. The standard also refers to NRV, which is the net realizable value, and this is defined as the selling price of your inventory less cost to sell or cost of completion. Now, the NRV becomes important when we are dealing with the valuation rule in IS2. Now, the valuation rule in IS2 says inventory has to be valued at the lower of its cost and net realizable value. That means that at the end of every reporting period, the entity has to assess which is the lower amount. The amount at which inventory was recorded when it was bought, so in other words, its cost, or its net realizable value. As I said, this assessment is done at the end of every reporting period. And what this then means is, if the net realizable value is lower than the cost at which the inventory has already been recorded, then your inventory needs to be written down to its net realizable value. What this means for the auditor is they need to ensure that this assessment was done by management, and if it did result in a write-down of your inventory balance, the auditor needs to be comfortable that that calculation is reasonable and that it has been correctly accounted for in the financial statements. IS2 also provides us guidance in terms of what exactly can be recorded as cost of inventory. So it is all the cost of purchasing, cost of conversion, or any cost incurred to bring the inventory to its present location and condition. IS2 specifically excludes storage cost, any admin cost, and any selling cost. So what this means for the auditor is the auditor needs to be happy that the management has complied with these guidelines in terms of recording the cost of the inventory items. All right. So have the correct cost been included and have these exclusions been correctly applied. IS2 also prescribes 3 different cost formula that can be applied when we are valuing inventory. Specific identification, the weighted average method, and first in, first out. Standard costing is also given as an option, and this happens when we are approximating costs. So when the auditor is auditing the valuation assertion, they need to understand which cost formula has been applied, and if in the case of standard costed being applied, the auditor needs to understand what would happen if the standard has not been measured correctly. What is being done with any variances from the standard? How are they being identified? How are they being treated when they do come up? And also, what about variances relating to an incorrect standard setting? All right, so understanding what that standard in terms of standard costing is very important for the auditor. When it comes to imported goods, the auditor needs to also understand and then also have comfort over the fact that the correct exchange rate has been used. The auditor is therefore concerned with 2 things at year end. The first thing is, what was the quantity of inventory items at year end, and has that quantity been correctly recorded in the inventory records? And then secondly, which cost formula has been applied, and has it been applied correctly? Now, to achieve this, the auditor then has procedures around 2 stages within the inventory cycle. The first part, to have comfort over the quantity, the auditor has to then attend the inventory count or the stock count. And then for the second part, which is then whether or not the cost formula has been applied correctly, the auditor designs audit procedures to audit the carrying value of the inventory at reporting date or year end. In terms of your inventory count or stock count, there are tests of controls that can be performed as well as substantive procedures. Now, important to remember that your substantive procedures have to be based on the following assertions: existence, valuation, and completeness. So also important to record your last document numbers, whether it's sales or credit notes or goods or delivery notes, and that is important for your cutoff testing. All right, so that you can ensure that the correct sales or the correct inventory has been recorded in the correct period. Okay, procedures around stock counts have already been discussed previously. There are certain procedures that need to be performed after your inventory count or post-inventory count. So the first batch of procedures has to do with rights and obligations as the assertion. Okay, if there is any consignment stock, have these been separately identified, and how have these been treated or accounted for in the entity's records? If there are imported goods, how have the exchange rates been applied? Have the correct exchange rates been applied? And is the auditor happy with the reasonableness of that calculation of imported goods? And if there are any goods that or inventory that are encumbered by the bank, has that been correctly disclosed, presented and disclosed in your financial statements? The second batch of assertion has to do with valuation and allocation. Okay, so very important here that your inventory value is equal to P times Q, with Q being your quantity that has been identified in your stock count, and P being the pricing, so the valuation of your inventory. The auditor there would be concerned with arithmetic accuracy and have these, or the amounts that have been identified as P and Q, are they reasonable? And has the correct cost formula been applied as per the company's policy? With regards to the valuation of your inventory, the pricing of your inventory is important, and the method of determining that pricing will really be based on the information that is given to you. All right, so read your question carefully. Which cost formula are you using? Are you using standard costing? So your audit procedures will be based on the information that is given to you. In terms of work in progress, an important part that needs to be determined there and that you need to audit is your stage of completion. And depending on the nature of your inventory, it might be necessary to consider using an expert in the determination of that stage of completion. So in terms of the valuation of your inventory and the pricing of your inventory, it's important to keep in mind the valuation rule as prescribed in IS 2, which says that inventory has to be valued at the lower of cost and its net realizable value. Alright, so that one speaks directly to the valuation and auditing around that assertion, which is valuation. Also important to keep in mind is that provision for obsolete stock or provision for damaged stock. Have discussions with management and identify any indicators which leads to a possible provision that needs to be raised, how that is identified, how timelessly management identifies these indicators, and have there been specific happenings within the reporting year which affects your provision for obsolete stock. If you do have that provision on your books, it's important that the auditor recalculates that amount or that provision amount, and that the auditor is then happy with how it has been calculated and the results that have been raised as a result of this recalculation. The completeness and existence assertions is mostly covered through your inventory count. However, there are some analytics that you could run on your inventory balance just to get some comfort around whether you are happy with the completeness and existence. As the auditor, you could compare total inventory balances between years or periods. You could compare inventory by category also by doing a year-on-year comparison of your different categories. You could also calculate inventory as a percentage of assets, compare that year on year. It could give you valuable information that the auditor can use in assessing whether the inventory balance is reasonable. So we'll end up this lecture with a short objective test. Here you are required to explain why the delayed inventory count could affect your audit strategy. So the information is as follows. You are the manager in charge of the audit of Company A large wholesaler of building supplies. The reporting period end is 31 March 2018. A week prior to period end, you receive a notification from the financial manager that the period end inventory count had been postponed for 2 weeks to 14 April 2018. The reason for the postponement was that Company A had entered into takeover negotiations with Company B. A result of the negotiations was that Company B would base their offer to purchase Company A on the audited financial statements as at the 31st of March 2018. As inventory is a very material figure on the balance sheet, it was agreed that the period end inventory count would be postponed so that more preparation for the inventory count could take place to achieve a more accurate count. So on this slide, there's just some information that you need to take into account in your answer. I leave you to it to just attempt this question, and then this brings us to the end of the production and inventory cycle.